All right, good afternoon, everyone. Thank you all for joining CRI's 2023 year-end tax planning for businesses. For those of you who are here for CPE certification and credit, CPE is offered for 1 hour for every 50 minutes for the taxes field of study, which is in the technical field. There is no partial CPE credit offered for this event. Please log in with your unique link and stay logged in for the entire webinar to ensure that you receive your CPE credit. Participants must answer at least 80% of poll questions to receive the full 1 CPE credit. Credits will be distributed via email within 7 days of the virtual event. Email certificates will be delivered from Carr, Riggs, and Ingram at support@prolera.com. Questions about the certification process can be sent to marketing@cricpa.com. And also please note that the PDF of the handouts of this presentation will be accessible for download through the Zoom chat. Now I'd like to talk and introduce you to our presenters today. First, we have myself. My name is David White. I am a partner in the Tallahassee office of CRI. I received both my master's and my bachelor's from FSU in accounting. As such, I am a fan of most FSU athletics and via my daughter, competitive dance. She can do things that would quite literally break my back. With my daughter and my family, we've recently this past summer taken trips to New York, Chicago, and Cleveland. And we have 2 animals at home, a cat named Cheese by my wife, and Harley, our golden retriever. Next, going to introduce you to our main presenters. I'm just the moderator here. First, we have Tiffany Orr. She received her master's degree from Valdosta State University, is a big fan of the Georgia Bulldogs, Go Dogs. She recently traveled to Rio de Janeiro in Brazil, and she has I'm going to err on the side of caution here, a Shih Tzu named Benjamin Button. Next, we have Brian Whitfield. He received his bachelor's degree from WKU and his master's from Belmont. He's an avid fan of golf and traveling to Hilton Head in Disney, and has a black lab mix named Palmer. Now, talking about the overview and agenda for today, we're going to talk about some evergreen topics as well as some very timely and new topics. Those being the Secure 2.0 Act, the Inflation Reduction Act, the Employer Retention Tax Credit, which has had its own evolution over the last several months, the Research and Development Tax Credit, the evergreen topic of deferring income and accelerating deductions, business deductions, estimated tax payments, state tax considerations, business entity comparisons, and any questions you might have. So to begin, I'm going to pass it over to Tiffany, who's going to talk about the Secure 2.0 Act.
Thank you, David. Good afternoon, everyone. Thank you for joining us. So first, we would like to touch on some recent legislation that could have an impact for your business. The first legislation that I will touch on is Secure 2.0 Act. The Secure 2.0 Act was passed on December 29th, 2022. And within this act, it provides credits to incentivize employers to fund retirement plans. So the first credit that I'm going to touch on is the pension plan startup cost credit. This credit is eligible for employers who have no more than 100 employees and did not maintain a retirement plan in the 3 years preceding the year that you have adopted this new plan. If you have employees 50 or less, you get 100% of the startup costs, up to $5,000 per year for the first 3 years. So that's a total, you get a total of $15,000 over those 3 years. If you have employees, your number is somewhere between 51 to 100, you only receive 50% of those startup costs, but it's still up to $5,000 for the first 3 years. On the next slide, I'm going to touch on what kind of costs can be included to calculate that credit. So the eligible costs are any ordinary and necessary costs to set up and administrate the new plan. Also, it includes costs to educate your employees about this new plan. So the second bucket, I just have an example of costs that could be included, but this is not an all-inclusive list. So you should definitely consult with your tax advisor, your financial advisor, or your retirement plan administrator to determine those costs that you're incurring to start up this plan. And in the last bucket, I just wanted to touch on if you're incurring costs to establish a retirement plan, but it's not effective until the following year, you have the option for that first year where you have incurred that cost. That's your first year that you're eligible for the credit. So for example, if you are, after you've taken this webinar with us, you say, yes, I want to do this, and you start incurring costs in 2023, but you don't implement and make that plan effective until 2024, 2023 is your first year eligibility for that credit. The next page, the next slide, I'm going to touch on this another credit. This is separate from the startup cost credit. This is the employer contributions credit. This is also new under the Secure 2.0 Act, and it provides a credit for employer matching or profit sharing contributions for the first 5 years. So this extends the credit a little longer than what we discussed for the startup cost. That's only 3 years. And it's for businesses. Again, it's up to 100 employees, just like the previous credit. The maximum credit is $1,000 per year for each of those employees. However, if you go over the 50 employees, you start incurring a phase out, which is 2%, which is 2% per employee. On this next slide, I'm providing just a breakout of how you get this credit. So for the first 2 years, it's 100% of employer contributions, but then it starts to phase out after that second year. So year 3 is 75%, year 4, 50%, and then year 5, 25%. And this last bucket, I thought this was some information that may be helpful. If you previously had a 401A, 403A, simple or SEP plan in those 3 years, because you know that was one of the requirements, you couldn't have had a retirement plan for those previous 3 years. If you did have one of these plans that I have listed here on this slide, you won't be eligible to take the deduction for that first year, but you may be able to take it starting that second year. So you lose 1 year of eligibility, but you still get years 2 through 5. So that's it for the employer contributions credit and the Secure 2.0 Act. The next legislation that I'm going to go to is the Inflation Reduction Act of 2022. It was also passed in 2022 in August, specifically of August 16th of 2022. And within this legislation, it provided an expansion of the energy credits. So your business could be eligible for a 30% credit for investments in wind, solar, energy storage, and other renewable energy products. And also, if we have any nonprofit business owners and any board members of nonprofit, you should also pay close attention to this credit because nonprofits are eligible for this credit. Nonprofits don't pay a tax, but it allows them to determine what their credit would be, and you actually receive the money. So you can use that money to fund projects for your nonprofit. So next, I'm going to hand it over to Brian to cover the corporate AMT.
Thank you, Tiffany. We wanted to highlight the corporate alternative minimum tax. It was a piece of the Inflation Reduction Act of 2022, but 2023 is the first year it's in effect. It's only expected to apply to about 150 US-based companies. We just wanted everyone to be aware of it and know that it was out there. The Inflation Reduction Act created a new corporate AMT applicable to large corporate taxpayers in 2023. The corporate alternative minimum tax applies to C corporations with average annual adjusted financial statement income in excess of 1 billion, and that's over a 3-year taxable period. The IRS also issued transition relief guidance for 2023 for penalties related to estimated tax payments, in case an applicable company was not aware of this. But the large C corporations will need to be prepared to determine if the corporate alternative minimum tax applies and calculate the AMT liability in addition to their regular tax liability. On the next slide, I'm just mentioning here, the corporate AMT does not apply to S corporations. It doesn't apply to regulated investment companies, mutual funds, REITs, or anything like that. Again, 2023 is the first tax year that it is in effect. And across those 150 companies that it is supposed to be applicable for, it's estimated to raise over $220 billion over the next 10 years. I think that's our first polling question.
All right, thank you. So now I'm going to launch our first polling question. All right, on a scale of 1 through 5, how are you today? All right, in the meantime, we have a few questions. While we can see that most people are doing pretty well. The first question is, are there any limitations or restrictions if the business is made up of primarily or totally of wholly of family members? I believe this is in relation to the pension plan startup credit. Tiffany, do you happen to have any thoughts off the top of your head?
Yeah, I can answer that. There isn't any limitations. If it's a privately held business, you're still eligible for that credit.
All right, great, thank you. Well, I'm gonna close the polling question in a few seconds. It looks like most people are doing well, doing great, or kind of neutral, meh. So I'm gonna go ahead and close this polling question, and then we're gonna move on. Right.
All right, so next, we're going to go over the employer retention tax credit. Of course, this has been a hot topic over the past few years, and this is related to the pandemic. And previously, last year, the presenters, they provided detailed information on how to apply for the ERC, like we like to call it, the deadlines and that process. We're not going to go into that detail. We're just going to cover updates. So the first update occurred September 14th of this year. The IRS placed a moratorium on processing any new claims, and the date was given at least December 31st, 2023. So it could be longer, but we know as of right now, at least through the end of the year, they will not be processing any new claims. And this moratorium is in response to just a surge of claims that they feel was fraudulent and questionable. So they want to take time to implement procedures to audit any client claims that have already been paid out and have procedures to process any new claims to make sure they are legitimate claims. So they have given a timeline. If you've already submitted your claim and it hasn't been processed, to expect that processing time to increase from 90 to 180 days. I know for a lot of my clients, it was already close to 180 days. So I would probably add a little bit more time. Just know that they will get to it as soon as possible. And then on the next slide, a month later, on October 19th, 2023, the IRS announced that there is now a special process where if you feel like your claim wasn't legitimate or you're not sure if the number is correct, you have an opportunity to withdraw your claim so you won't get subject to an audit and maybe even having to pay penalties and interest for a fraudulent claim. So the next slide, I'm going to touch on various scenarios. The first one, if you use a professional payroll company, you should consult with your payroll company. If you filed your own claim and you haven't cashed or deposited that refund check and you haven't been notified that your claim is under audit, there's a withdrawal request form that you can send to the Internal Revenue Service, and there's a fax number that you can send it to. If you've already been notified that your claim is under audit, you can send that withdrawal request to either the assigned agent that will be handling your audit. And if you haven't received notice of that assigned agent, just respond to the notice with that withdrawal request. Lastly, if you've already received the check but haven't cashed it or deposited, you have the option where you can void the check and send it back with that withdrawal request. At the bottom, there's a link to the irs.gov website that provides additional information on the process to withdraw a claim if you feel like you need to do that. And next, I'm going to pass it over to Brian for the research and development tax credit.
All right, so we wanted to highlight the research and development tax credit, the R&D tax credit. The research and development tax credit is a federal tax liability reduction that companies can take for approved domestic expenses. The rate of reduction is dollar for dollar, so that's nice. And you can also get back approximately 13 cents for every dollar spent on research that meets eligibility requirements. Qualifying research and development expenses include the development, improvement, or design of a product, technique, process, or software. Basically, any major overhaul of either a product or software that your business is working with. The credit is claimed on Form 6765, which is nothing that you would need to necessarily know, but it can lead to significant savings that free up cash for either further R&D, hiring new employees, and even more savings for your business. The companies that meet the criteria of a qualified small business, the R&D credit can also be used to offset quarterly payroll taxes. And in order to offset this, for previous years, for 2016 through 2022, the maximum R&D tax credit for payroll tax that you could use was $250,000. The credit doubled to $500,000 beginning January 1st, 2023. So there is significant savings there. In many states, we're also starting to have also enacted an R&D credit. Now, even if you're not taking advantage of the R&D credit, there was a law change that started in the 2022 tax year, and it was under Section 174. Again, this isn't new for 2023, but we did want to highlight it in case you either weren't aware of it in 2022. Or you just wanted some further clarification on what it was. Section 174 said that beginning in the 2022 tax year, taxpayers have to capitalize all research and development expenditures paid or incurred in connection with their trade or business, whether or not they were taking the R&D credit that year. These costs are then amortized over a 5-year period. This is significant because in the past, taxpayers could immediately deduct R&D expenses from their taxable income. And now suddenly that has to be spread out over 5 years. This change was enacted as part of the Tax Cuts and Jobs Act, which was from 2017. And again, it is applicable whether you're taking the R&D credit or not. R&D expenses, they're loosely defined because it's not actual specific types of costs that you're incurring, but rather it's based on the type of activity that a business is engaging in. The IRS says that R&D expenses are present if a taxpayer develops a new or improved product, service, or developed software, or even has a significant overhaul of a product that's already active and placed in service, a software that's already active and placed in service. There's been a lot of talk in the news as well. And, we have been following very closely the guidance that's been coming out. This is such an unfavorable change that there's been a lot of support to repeal Section 174 and go back to the old rules of being able to deduct in the year that these expenses were incurred. However, as of today, Section 174 is still in effect. Just know that if the bipartisan support does go through, this could revert back to the old rule. But as of right now, we're kind of planning worst case scenario and planning, the conservative route to say that expenses would have to be capitalized and spread over 5 years. So this slide just kind of highlights some of the expenditures that would be required to be capitalized. I won't talk through all these, but you will see on here, it's not specific costs. I mean, there's wages of the applicable employees. There's cost of supplies, there's overhead expenses, including rent, utilities, those kinds of things. And so it really requires a lot of documentation on the client's part and, either their part or working with an expert to identify pieces of these overhead expenses of these of wages and things like that you would need to allocate under 174, and then that would be spread out over the 5-year period. So next we're going to go into kind of some tried and true tax planning items. Your general rule of thumb of you want to defer income and accelerate deductions. So we'll start by talking about tax rates. As you know, C corporations have a flat 21% tax rate, and they've enjoyed that for a few years now. But pass-through entities are taxed at the individual level. This can be really beneficial and really be something to pay attention to, because if a taxpayer expects taxable income to be higher in 2023 than 2024, or if they anticipate being taxed at a higher rate in 2023 than 2024, then it could be beneficial to defer income into the next tax year, into that 2024 period, if they have the opportunity to do so. And one way to do that is when we talk about your method of accounting. You may have heard your tax partner or your CPA talk about the cash method, accrual method, for tax purposes. So, excuse me, when filing a tax return on the cash method of accounting instead of the accrual method, it generally puts the taxpayer in a better position to accelerate deductions and defer income. So we get a lot of questions a lot of times on, should I be cash basis? Should I be accrual basis? Majority of the time, the answer is going to be cash basis. That's the best way to go, because you recognize income as cash is received. And similarly, you recognize expense when cash is paid out. Majority of small to mid-sized businesses are cash basis, regardless of if you're using accrual basis on your books. of using AR, AP to track things internally. If you're wanting to make a change, or that's something that you do want to explore for tax purposes, this has to be done before the due date of the return, but that due date includes any extensions that you have on your return. Next, I wanted to mention installment sales. So I work with a lot of transportation companies. I work with a lot of contractors in that space. And so this is something that we do see quite often, especially in the current climate. With an installment sale, a sale generally occurs when there is a transfer of property. And if you're going to have a gain on that sale, the income is received, or the income is recognized when the payment is received. So when you're dealing with an installment sale, if you expect a business to or if you expect a sale to happen, say at the end of 2023, and it either makes economic sense to collect in 2024, or there's some sort of agreement, like a seller financing agreement, where you're not going to receive payment on that sale until 2024, that becomes an installment sale that you're deferring gain into a later tax year. We do see a lot of installment sales, like I said, of the seller financing route, because it can be beneficial for both parties. Of the buyer, one is receiving that financing if they need any kind of special financing arrangement, and two, as the seller and the person giving that financing, you are required to charge interest on that financing. So with interest rates being what they are, that does give you an opportunity to collect additional income on that through the interest that you're going to charge on that sale. Another good practice, whether you're cash basis or accrual basis, at the end of the year, is to review bad debts. All outstanding accounts receivable should be looked at the end of the year, if you're not doing that even more often than that. If there's receivables that you see in your AR ledger that you determine that, for one reason or another, we're not going to collect this, we don't think we're going to get it, this should go ahead and be written off, and those should be written off before the end of the year instead of after the first of the year. Because as an accrual basis taxpayer, if you write off an accounts receivable account before the end of the year, that creates a deduction in the current year, or it creates a deduction in the year of the write-off. But if you do it before the end of the year, that gets you a deduction current year. So that accomplishes the, we're going to accelerate deductions. If you are cash basis, again, if you're keeping your books on accrual basis, you still do need to review your outstanding AR, but you're not going to get a deduction in the current year for cash basis because you haven't recognized that income previously. But it's just a good practice to be in for your books. And the last the last piece I'm going to talk about on this topic is on year-end bonuses. So a taxpayer that accrues an employee bonus can take a current year deduction for bonuses paid in the following year. And that is whether you're cash basis or accrual basis, so long as certain criteria is met. The company would not have the right to cancel the bonus anytime prior to the payment. The amount of that bonus does have to be fixed and determinable. And the bonus would need to be paid within the 2.5 months after the employer's year end. So that's the first 2.5 months of the next calendar year, in order to deduct it in the 2023 tax period.
All right, thank you. And with that, we have our second polling question. are you attending this webinar for CPE credit is the second polling question. And while some people are answering that, I have a question from one of the participants. And this is for either of you. Do you know of any way to check on, and there might be more than one answer here, so just share your thoughts. Do you know any way to check on or check with the IRS that they have the ERC, Employee Retention Credit, claim in process? Do either of you have any recommendations for how to get a sense of where things are if you've already filed an ERC claim?
I could take that. I know for our ERC team in my office, they have to call and check on the status.
Right, so maybe getting a power of attorney signed and calling and asking?
Yes, yes. So you can either have your CPA, you can do a power of attorney and have them call on your behalf. Or if you use the payroll company, have them call because they filed it. So they're able to call on your behalf.
Okay, so to the person that asked that question, there is not a simple answer similar to how one can, as an individual, if you're due a refund, there's a nifty little tool that you can use on the IRS's website to track that. With this more complicated credit claim, it's the best recommendation that we have, and Tiffany, I agree with you, is to have either you or a professional, your advocate in this matter, call the IRS to inquire. Okay, so I'm going to end the poll. Seems like most everyone has answered. And it seems that most people, over 80%, are here to receive CPE credit. Again, just as a reminder, you have to answer at least 80% of the CPE or the polling questions in order to receive CPE credit. Okay, so now we're going to discuss business deductions.
All right. So we wanted to highlight a couple business deductions. And again, these are deductions that have been around for a couple of years, or there may be a small change here, but we do just want to highlight these, make sure you're aware of these, and make sure that your business is taking advantage of them if you're able to. The first one is qualified business income, or QBI. Most people by now have heard of QBI because, again, this was a piece that came into effect in the TCJA several years ago in the 2017 tax law change. But many owners, and these are going to be only for pass-through entities, for sole proprietorships, partnerships, S corporations, and then some trust and estates could be eligible for a QBI deduction. And what QBI is it allows eligible taxpayers to deduct up to 20% of their qualified business income, plus 20% of qualified real estate investment trusts, dividends, qualified publicly traded partnership type income. As I mentioned, income earned through a C corporation, or in the case of providing a service as an employee, is not eligible for this deduction. Big item to note here is that now that we've enjoyed having the 20% deduction, that 20% haircut off the top for the last several years, 2023, 24, and 25 under current law are the last years that we're going to be able to take advantage of this, as it is supposed to sunset after the 2025 tax year. Excess business losses. Taxpayers other than C corporations are not allowed to deduct excess business loss. If you feel like you are going to be in a loss position, it is going to be beneficial to make sure that you do talk to your tax professional, because an excess business loss is the amount by which your deductions exceed the income that you receive from your trade or business. Those business losses then are, they do have limits of that you can take in the current year, that gets passed through to your individual tax return. And for those limits for married filing jointly are 578 for the 2023 tax year. All other taxpayers, your singles, your head of household, that is limited to 289,000. And then any excess business loss that you have is carried forward as part of your net operating loss, or your NOL, for the next year. So talking about NOL, we wanted to highlight that here of, again, if a taxpayer expects to incur a net operating loss for 2023, the net operating loss can be carried forward indefinitely, but the law has changed that you can no longer carry this loss back. If the taxpayer has any NOLs carrying forward from prior years, it's really important to note and to have the detail to say what years these NOLs stem from, because the treatment of it differs based off the year that the NOL was created. So losses arising before 2018 are deductible up to 100% of your current year taxable income, but losses arising after 2017 are limited to 80% of taxable income. And this is a huge point in planning, because if you do have NOLs carrying forward, and you're expecting then income in the current year and wanting to use that net operating loss from a prior year to offset it, just make sure that you touch base again with your tax professional to know what year the NOL stemmed from. One change that does start for business deductions, that does start in 2023, is what's called bonus depreciation. Most taxpayers that have equipment, have capital assets, are aware of what bonus depreciation is. And that's just basically a way to accelerate the deduction for those capital items in the current year. The last few years, again, we have enjoyed a bonus depreciation of 100%, meaning we could deduct the entire amount in that first year. But bonus depreciation does start to phase out and goes down to that 80% level in 2023. You can see the schedule there of how it is supposed to continue to decrease under current law over the next couple of years. With the reduction of bonus depreciation, there still is Section 179 depreciation to be aware of. And this is another way that you can accelerate and take the whole deduction in the current year. I've got the limits for 2023 listed there. And the maximum that you can take is that 1.16 million. That having the limit is a difference from bonus depreciation. Bonus doesn't have those limits, but just do be aware that 179 does have that. The deduction is also subject to business income limitation, meaning that your business has to have income in order to take Section 179, which is a big difference from bonus. Of bonus, you can push it into a loss. The other reason I wanted to make sure and highlight Section 179 is if you are somebody that has rental properties. For non-residential real property, so commercial property, there are components of the building that, while not eligible for bonus, you can take for 179. I've got a couple of them listed here, like roofs, HVACs, security systems, that under 179, again, for only commercial rentals, you could take a 100% deduction in the current year. Another change, going on to the next slide. For 2023, Again, we have benefited from 100% deduction for meals over the last couple of years. The rule for meals in 2023 reverts back to the old rule of only 50% is deductible. Entertainment expenses do remain 100% non-deductible. And so as a point of planning and good practice, if you don't already have in your chart of accounts where you're splitting out meals and entertainment in separate accounts, it might be a good idea to start implementing that, so that you are aware that the entertainment is 100% non-deductible and you get 50% of those meals. Next, I'm going to just talk about charitable contributions quickly. C corporations are allowed to deduct charitable contributions up to 10% of taxable income. And then, of course, pass-through entities allocate those contributions to those owners, and then the limits are set at the individual level. An individual is allowed to deduct up to 60% of their AGI through a charitable donation in the current year. Again, a planning point, if you are planning to make a large donation towards the end of the year, you may check with your CPA on the timing of that donation so that they can estimate what your AGI is going to be in that current year, and also take into account any other charitable contributions you may have already made for that tax year. It's also big to check with your CPA because depending on what you are donating, there could be additional requirements there of if you're donating stock, if you're donating property, that you may have to have an appraisal done, you may have to have certain forms signed, additional documentation that you do have to supply with your tax return. And then I think this kicks it back over to Tiffany.
Yes, thank you, Brian. So the next deduction that I'm going to touch on is the home office deduction. Nothing has changed with the home office deduction, and this isn't a new deduction for businesses, but I have seen, and in our office, we've seen that this has been a hot topic as businesses move to more of a hybrid model. So you may come in the office some, you may work from home some. So I get a lot of questions on, am I eligible for the home office deduction? So we wanted to provide an update on that and just provide clarification. If you use your home exclusively and regularly for conducting business, you may be eligible for this deduction. And it's available if you own the house or if you rent. So it doesn't matter if you're an owner or renter. But you must be able to prove that your home is used as your principal place of business. And this is very important because if you just have a home office out of, you like to stay and work at home some, but you still have an office that is your principal place of business, that does not make you eligible for the home office deduction. And I always give my clients an example when determining your principal place of business. When you do that corporate registration for your business, which address are you using? Do you have an office that you're renting and that's your address, or is your home listed as the address for your business? So that's a good tidbit. Of course, that doesn't mean that is the catch-all for determining if you're eligible, but that is an example. And for the home office deduction, just if we have any new business owners on here, it's a way to prorate home expenses that you're incurring, and you have to do a calculation to determine how much of your space is used exclusively for your business, and then you take a ratio of the total space of your home, and then that's what you use to allocate the expenses to calculate that deduction. And next, we're gonna move to a new topic, estimated tax payments. For both individuals and businesses, if you're not paying taxes throughout the year. So for example, if you're an employee, you're receiving a W-2, your employer's taking out taxes throughout the year. When you're self-employed and you're running a business, it's on you to pay those, to make sure you're paying those taxes throughout the year. So we call them the quarterly estimated tax payments. So for corporations with taxable income less than $1 million, If you're paying at least 100% of the prior year's tax, you can avoid that underpayment penalty. So that's just a safe harbor to make sure you're paying it enough. If your income fluctuates up and down, that's usually a good indication to determine, okay, as long as I pay in this much, I won't incur that underpayment penalty. And also I wanted to point out, if you're in a state where that now has the pass-through entity tax, and as for your business, you have elected to do that, remember that you also need to make the estimated tax payment to the state for your business income.
All right, thank you, Tiffany. We now have our third polling question. All right, are you still there?
Hopefully we haven't lost anybody yet.
Yeah, or a little suspicious over people saying they're not there, yet answering, or yet somehow able to answer. But overall, a good, healthy response so far. And we don't yet have any we don't yet have any questions out there. Although there was one, Brian, that perhaps you might be able to touch on. We had a couple questions. One is, if a restaurant is developing new menu items, do these costs qualify for the R&D credit? I'm not sure if that is too specific of a question, or if that's something you might be able to broadly touch on off the top of your head, Brian.
Yeah, so I'll give somewhat of the classic accounting answer of it does depend. There are applicable R&D costs for the food and beverage industry. And that can be developing new ingredients, new formulas, new flavors, new products, those kinds of things. I think generally you would think of kind of your larger food manufacturers when you're doing that, they are creating a new product that is within the food and beverage space. But if it's improving upon a existing recipe or changing just a small change on a specific menu item, that probably wouldn't be R&D or something that we would think of there. I would think more of an overhaul, kind of that larger scale in the food and beverage industry.
Great, thank you so much. I'm going to go ahead and end this poll now. And 97% are here, 3% answered they are not here. And with that, we're going to move on to the next slide regarding state tax considerations.
Yes. So we're going to briefly touch on some state tax considerations. We know that we have business owners and taxpayers from all over, all states. Some states do not even have a state income tax. So this may not be applicable to you, but we just wanted to touch base on it because someone on the call may need some information. So the first state tax consideration would be depreciation adjustments. Brian just provided a great update on the bonus depreciation, the section 179 depreciation. But for some states, they do not recognize this. They do not conform. So you need to make sure you're consulting with your tax advisor to determine if there will be an add back or an adjustment for your state income tax return. The second item will be for law changes. And on the next slide, Brian's going to touch on a specific law change for the state of Tennessee, because that's where he practices. Next, I'll touch on the pass-through entity tax. High level, each state is different, but I will just provide some broad information on the pass-through entity tax so you have something to take away from the webinar and discuss it with your tax advisor. And lastly, I will discuss the impact of the pass-through entity tax on some state credits. I practice in the state of Georgia, so I have an example to provide. So next slide.
Yeah, so thank you, Tiffany. I mean, as she said, we just wanted to highlight some of the items with state tax that are out there. We could teach an entire class on state tax specifically, and an entire class on each state that we do all practice in. But mainly, I just wanted to put this up there because one, I do practice in the state of Tennessee, but two, the Works Act in Tennessee that came into effect or goes into effect for the 2023 tax year does highlight some specific areas of state tax that you do need to be aware of. So in this law change specifically for Tennessee, Tennessee is going to a single sales factor when it comes to apportionment. And that's going to start in Tennessee for 2025, but that is a very common thing that we are seeing amongst a lot of states, that when apportioning income to states, no longer are states using the sales factor, the payroll factor, the property factor. It's becoming more and more common just to see sales, as we have a lot of remote work, as we have a lot of those things in effect now. Tiffany also mentioned, when it comes to depreciation, do just be aware that there are multiple components of your tax situation. It is your federal and it is also your state. So when it comes to depreciation, if you're planning your income for the current year, your state may or may not conform to the federal rules for depreciation and for accelerating that deduction in the current year. Tennessee is going to start allowing bonus depreciation for assets purchased after January 1st, 2023. But I would say, more often than not, we do see states that do not follow bonus depreciation. We'll see if that continues to change. Tennessee also put an exemption into effect, that there are earnings that they're going to start exempting from their franchise and excise tax, and majority of states do have an exemption. So again, that is something to be aware of as you're entering a new state, as you're trying to decide where you want to file in the current year. Do look and see if that state, or ask your CRI professional if there is an exemption in that state that you can pull out of your income for the current year.
And I will touch on the state pass-through entity tax. This was new for us for 2023. And it's available for S corporations and partnerships, pass-through entities, where you can elect to pay tax at the entity level. And this was implemented as a workaround for that $10,000 limitation on an individual tax return, where you can only take up to $10,000. But for a lot of business owners in these pass-through entities, they were paying way more than the $10,000, because that includes your income tax, your property taxes. So this was implemented and a lot of states have adopted it, where you're able to make this election. However, each state is different. It's not a catch-all for every state. So you need to make sure you're consulting with your tax advisor in your state to see if this is something that you can do. And there's also various options on how you elect into this. So some states, it maybe you just have to check a box. Some states, you have to submit a separate form before a certain date. So make sure that you just have that on your radar. If this is something you want to do, you should discuss it with your tax advisor. I would say sooner than later, because it may be something that you need to do before the end of the year. And also, I wanted to point out for the pass-through entity tax, it's not the right answer for everyone. So you should definitely do an analysis and see if it works for you. It may be a situation where the partners in this partnership, they have all these credits or these losses, or they maybe have retirement income exclusions on a state level where it doesn't make sense for them to do this. So you definitely need to make sure that you're looking at it from your personal standpoint and not just saying, I'm gonna do it because everyone else is doing it. And lastly, for the state state pass-through entity tax, specifically for the state of Georgia. We have this education credit called the Georgia Gold. And previously it was available for pass-through entities, these S corporations and partnerships, where you're able to pay for this credit and it passes through to the owners. We noticed as we were working on tax returns this year for our owners, if you elect in this pass-through entity tax, now you lose that credit. So that's something else that you should take into account if your state has some special credits that may not work well with this pass-through entity tax election. All right, and last section, we're almost done. The business entity considerations. None of this information is new. We just thought we should touch on it because we may have some new business owners on the call that, you know, you're at the starting point. You're trying to figure out what type of entity you want to create for your new business. So there's 5 options. You have the sole proprietorship, the limited liability company, which is very popular, the partnership, the S corporation, and the C corporation. Next slide. Here we have provided just a summary of the number of owners for each of these type options. So for sole proprietorship, that's one person. For a limited liability company or LLC, like we like to call it, you could have one person, which we call a single member LLC, or you could have multiple members in that LLC. Partnership is at least 2, S corporation up to 100, and then a C corporation is unlimited. You can have as many owners as you want. And the next slide, we wanted to touch on the limited liability protection because that is very important when considering the startup for your business. The limited liability protection protects your personal assets from the business. So if something was to happen with your business, no one could come after your personal assets if you have that limited liability protection. For a sole proprietorship, it's easy, but it does not provide that type of protection. LLC, of course, it's in the name. Partnership, it depends on the type of partnership. So you should discuss that with your tax advisor and maybe even your business attorney to determine if how you want to set up that partnership if you have 2 or more owners. And then S corporation and C corporation, yes, they both have that limited liability protection. And lastly, of course, because this is a tax update, we wanted to touch on briefly what tax filings would come with each type. So for a sole proprietorship, it just goes on a Schedule C of your Form 1040. So there isn't an additional tax filing. It just goes on your personal tax return. For a limited liability company, it depends on what category you pick for the LLC. If it's just one owner, it could go on a Schedule C, like a sole proprietorship. If it's multiple owners and you want to be treated like a partnership, then it goes on a partnership income tax return, which would be a 1065. And then if you elect to be an S corporation or a C corporation for the LLC, it would be an 1120S or an 1120. And so I already covered the partnership S Corp and C Corps. So now I think the last polling question.
That is right. Thank you. All right, now for our final polling question. Have you followed at CRICPA on social media? And again, don't forget, it's a little too late now at this point, but I can reassure those of you that have been here that you needed to be on the call for on the webinar for at least 15 minutes and answer 80% of the polling questions to receive the full 1 CPE credit. And those CPE credits will be distributed to you within 7 days after this webinar. So given the time, I'm gonna go ahead and end this polling question. Seems like most either have already followed or will and need to follow CRI on social media. So we have been answering questions in real time for the most part throughout this webinar. However, if we did not get a chance to address your question and you have some, these are our this is our contact information here. Again, my name is David, and our presenters today were Tiffany and Brian. And we have been from and represented 3 different states in our where we have CRI offices in Georgia and Florida and Tennessee. And of course, as to the prior polling question, if you have any more questions or any desire to have more insights into not only what we've talked about, but also future accounting in public accounting developments, you can follow CRI on one of a variety of different formats. So thank you again for being with us today, and hope you have a good conclusion to your year. Thank you.